Happy Monday, everyone. It is time for another Macro Monday, where I get you ready for the week ahead in 5 minutes or less. As always, just a reminder, this is a small snippet of our full Macro Monday newsletter. So if you're looking for more in-depth coverage from us, I will post a link to our full newsletter in the description of this video. Highly encourage you guys to check it out. As always, we will get started here with our chart of the week. And at this point, I know most of you, if you've been here, you're probably not surprised. We are once again hyper-focused on labor markets. In particular, we're focused on how tight labor markets currently are and how we believe that will lead to wage inflation. This is important as wage inflation is a core component of overall inflation. We've been especially focused recently on the native versus foreign-born labor force breakdown. Over the last 3 months, the U.S. has lost over 1 million foreign-born workers. That drop in labor supply is a key driver of upward wage pressure, and if anything, the pace of this trend is set to worsen. We're saying this because if you take a look at the amount of money allocated to immigration enforcement in the Big Beautiful Bill, it certainly doesn't signify that deportations or encouraging foreign-born workers to leave or exit the workforce is going to slow down anytime soon. And this could lead to serious problems to U.S. labor market dynamics. Moving on, finally, we have a big economic data week. This might actually be the biggest week of the year for economic data. So I'm probably going to miss some stuff, but I'll get through as much as I can. All eyes will naturally be on the FOMC meeting and Friday's July payroll report. We also get several PMI releases, including the ISM on Friday, the first look at Q2 GDP on Wednesday, and then core PCE on Thursday. Zooming in on some particular data points, on Tuesday we get consumer confidence. That continues to rebound. Retail sales are posting low to mid single-digit growth. This is underpinned by solid credit availability and a healthy labor market. The unemployment rate is still near 4.1%. As of right now, tariffs haven't put much of a dent into consumption. However, core CPI rose to 2.9% year over year in June. And here at the Macro Institute, we expect more price pressure coming this fall. As mentioned, we're going to talk some more about the labor markets here. Labor markets remain tight, and we believe they will for the foreseeable future. This week, so on Tuesday, we get the June JOLTS data, including the quits rate. This bottomed out at 1.9% last November, but it has since climbed to 2.1%. That's a subtle move, but it's an important signal of growing employee confidence and wage bargaining power. Again, as mentioned on the previous slide, we'll be especially focused on data that show the breakdown between native versus foreign-born labor force. And then finally, last but not least, what a lot of people will be paying attention to, Wednesday at 2 p.m., we get the FOMC's rate decision and Chair Powell's press conference. We don't expect a cut, and neither does the market consensus. From our perspective, the Fed simply does not have the data to justify currently easing interest rates. Weakness in employment would be the likely catalyst for the 50 basis points of rate cuts that are currently expected by the market in 2025, but that scenario just has not materialized, and the Fed will likely remain patient. Our framework here suggests that the macro backdrop argues for a more hawkish Fed stance, but I'm not sure if we'll quite see that. So that's what I'm going to leave you here today. Happy Monday. Thanks for watching. I hope everyone here has a great week. Don't forget to subscribe, and I will see you right back here next week for another Macro Monday.